Welcome to TMS Insights. It's February, which means reporting season, which means it's busy, and a lot of companies giving half-yearly or yearly updates, providing guidance for what's 2020 going to look like, 2021 going to look like for them, Ben. But we wanted to talk first about something which colours the whole market, and that's the bond market, which is a much bigger market than equities. And we were telling you at the end of last year how supportive 10-year bonds were of equity prices. And to start 21, it's gone back pretty much the other way and quite violently, Ben.
Yeah, and equity markets ultimately are priced off bond markets, and we've seen some pretty weird movements within the market, which I'm sure we've all been getting questions about, and it's probably the simple explanation. We put up a chart here which shows the 10-year Australian government bond yield over the last 12 months. And what you can see is a significant jump, particularly in the last week or two, up to around 1.4% now that's yielding. And, that was at about 80 basis points or 0.8% last November. Now, the 10-year bond yield is effectively the cash rate that the big players in the market can park their cash at. So whereas our clients, if they wanted to sell some shares and go to cash, the rate hasn't changed for them because the short-term rate is unaffected. But for the big pension funds, sovereign wealth funds, etc., the rate has almost doubled this year, and that's a big move. The other thing I would say that's been happening, particularly it's kind of pronounced early in the reporting season, is the offshore growth stocks, which typically trade on higher PEs, have definitely run into earnings issues as a result of COVID. In places like the US and all around the Northern Hemisphere, there's lockdowns, etc., big changes in customer behaviour, and it's causing a lot of issues for a lot of companies that operate in those markets. And at the same time, you've got this acceleration in the local government bond yield, which would always see a rotation of money into cheaper stocks out of more expensive stocks. Is that a good summary?
It is. Look, I think one of the things to roll that into the stock side of things, we've seen the recovery in the bank stocks.
Yep.
And that's a really big sign of how important and sensitive they are to bond yields.
Yep.
And valuation-wise and everything, seeing their margins potentially expand is what's breathed life back into bank stocks, which has been a fair part of why the index has begun to recover.
And the other thing I'd add is that early days again, but businesses that are sort of wholly focused on the Australian economy, such as the banks or other companies, are exceeding analysts' expectations because the economy here is so much stronger than everyone thought it was going to be. There's a lot of money trapped here. We know that $60 billion a year is spent by Australians travelling overseas, and that's being spent in the domestic economy. And that's the other reason the bond market is doing what it's doing, because economic growth is much stronger than everyone thought it was going to be.
Exactly. And just one thing you mentioned, Ben, at the low end, we're still seeing the 90-day bank bill very low. That's being managed low by the RBA, and they said they're going to do that most of the rest of the year and probably out through to 2022 or 23. So expect the short end, which is what prices term deposits and the like, to remain very low, and yet we've seen a normalisation in the yield curve with the long end bond yields rising.
And just the last point I'd make before we go into some results is this also has knock-on effects for infrastructure stocks, for property stocks, which have bond-like characteristics and are priced off the bond market and are very interest rate sensitive. Yeah. So if you're looking at Transurban, Australian Pipeline Trust, there's also some with some COVID issues. I'm thinking, why is that dropping when the yield's still really good and the cash rate hasn't changed? That's the reason. And where it goes from here will ultimately depend on what the bond market does from here. I think it's going to settle down at some stage, but everyone's got an opinion.
It'll all be to be resolved. But the other sector I'll mention on the flip side, which is typically always benefiting at the same time this happens, is the commodity space.
Yeah,
so our commodity stocks are going great guns at the moment. Let's start with CommBank, because we talked about banks, and again, Ben, this is very much a play on 2020 was expected to deliver the nasties and it hasn't. And so the news is less bad.
Yeah, yeah.
And the bank is in good shape.
Yeah, I think we've seen trading updates from the other three majors as well. And what you've said it perfectly there. You'd look at the numbers and think, 1% cash earnings growth, it's not that great, but the market was expecting a lot less. And so, it's just a reminder in earnings season, it's not a measure of how well a company's doing, it's how well a company's doing versus what the market thought it was doing. And with the banks, we're seeing a much softer landing in their earnings than we were expecting because CBA would be, it's really the pulse of the economy. If there's one business you would look at to get a feel for how the economy is going, it's Commonwealth Bank.
Yeah, it is. And the part that most impressed me, Ben, and it's not just CommBank, is how they maintained their margins. Remember, we were in recession second quarter last year.
Yep.
Okay, so they've maintained above 2% on their margin.
Yeah.
It was expected to get really nailed.
Yeah.
The low rate environment. So they've managed that very well.
They have, and we've seen some of the neobanks going bust. ME Bank is reportedly about to be bought by ANZ. So, this wave of competition we thought might be coming doesn't look like it's going to happen, and it's, the banks are flexing their muscles again.
Yeah, exactly right. Switching tones a bit there, let's talk about BHP because we mentioned that just now. Iron ore has been a phenomenon for them, but it's not just that. No. Base metals, and we know how well they've done. A good result, big movement after their result too.
Yeah, and really I think driven by the fact that they've taken the shackles off the dividend payout. They've really exceeded the market's expectation on the dividend, and it's probably a bit of a sign of confidence. There's a new CEO in there, and he's sort of setting his own agenda. And Fortescue's one that we've seen do the same thing today.
Yeah, massive dividend there, $1.47 fully franked. Yeah. And that's got bold plans for re-engineering its future. We should also mention RIO, whose numbers were good again.
Yeah,
so this space, I think a few investors have been caught a little short in this area too.
Yep.
But if you're wanting high yield, it's still a place to look.
Absolutely. And, the big question will be, when do we see a normalisation in commodity prices? But it's looking a bit further off. And what we were talking about earlier with bond yields and the outlook for the economy, it's happening everywhere in the world, we should have said. We're seeing the US, the government bond yield, 10-year has hit a one-year high as well. So there's global demand building, and that should feed into commodity demand.
And the thing I noticed out of the Fortescue result is they've now hit cash operating costs equivalent to Rio and BHP of 5 years ago.
Wow.
They're now $13.50 to $14 a tonne. So it's just incredible how much cash surplus they create. A couple of our favourites in the portal space. REA Group's been an absolute terror this year, and car sales has had the most interesting recession ever. And done phenomenally well, hasn't it?
It has. The car, it just spins your mind, these weird knock-on effects that every CEO is talking about, just shaking their heads. And all, Cameron McIntyre at car sales was just saying, when is this going to normalise? We've got no idea. But he sort of said, who would have guessed used cars would go up in price by 25% over the last 12 months. New cars, almost impossible to source because they're all trapped overseas. And Australians spending money like it is going out of fashion. And, loading up on cars, the weirdest recession ever. And REA was just a phenomenal result in a very difficult environment, given Melbourne was in lockdown for a lot of the last 6 months. But again, took a lot of cost out of the business. Revenue is taking off and will continue to because the housing market's going nuts. And the profit will follow.
Talking about another very solid business, a mature business, Coles, supermarkets and liquor. Great numbers on last year, but they warned about next year because they'll cycle those numbers and won't probably repeat them.
Yeah.
And the market has got a bit scared by that, I think, which is probably a bit surprising either.
Yeah, I just think some CEOs are definitely sort of saying, look, the spending behaviour we're seeing, it's not going to last forever. No. And things will normalise, particularly as travel starts to go again. That's going to be the big part of it. And, I thought it was actually a really good thing for him to say, which was to dampen down some expectations. And it is, I think it's worth remembering that some of these weird bubbles that we're seeing in spending across different industries, maybe another 6 to 12 months of it, but the market will start to price the normalisation at some stage.
If we start spending that $60+ billion per annum on travel, it's coming from somewhere.
Yeah, yeah.
So Iris, that result, Ben, what do you think of that one?
Well, it's a more mature technology business, but we use its products every day, and we know that we could never leave. We get sent a bill every year that's our prices are going up 10%. I think they've done a great job in sort of dominating their industry and the financial planning industry as well. Pay a really nice dividend. Hard to complain. It was a good result.
Wesfarmers, obviously Bunnings. I mean, we talked just before about how companies were doing well, and we all know how well Bunnings would have done. This result exceeded expectations.
Yeah.
It's a phenomenal company.
It's amazing. And, of course, everyone's been spending money on their houses because they've been stuck in them. Bunnings was one of the only stores that was allowed to continue to trade during lockdowns.
No sausages, though?
No barbecues. Officeworks, did phenomenally well on everyone having to work from home. And even Target and Kmart showed some pretty positive numbers there. So, Wesfarmers, as probably the next one we'll talk about, CSL, you could almost set your watch by. It's such a consistent business that, regardless of the environment, continues to look after its shareholders and grow its earnings. CSL.
Let's do that. What a stock.
Amazing.
Again, let's take everybody back a little while. Securus, the flu business, they bought from Novartis, really built that up. They invested in it, lost money for a few years in it. It came home to roost in this result. 680
million odd EBIT in the first 6 months. It's insane. And it offset the issues that they're having in America, where they, have an enormous blood collection business, which has been heavily impacted by stay-at-home orders. This huge storm now, the CEO was saying, has blanketed large parts of their collection centres. And, they're only collecting about 80% of the plasma. And he was saying, they've had to stop taking on new customers because they're worried about supplying their existing customers. The market has got so tight. But Securus made up for it. And it's all a part of the company continually reinvesting back into itself. And, his closing comment on the earnings call today was, we are CSL coming out of COVID will be an even better business than it was going into it.
And we tend to think, and we know this company well enough to know this, the guidance is very conservative.
Completely. One of the analysts I follow the most closely with CSL he's followed it for 20 odd years. He was saying to the CEO, you're a mile ahead of where I thought you guys would be in the first 6 months. How can you be maintaining your guidance? It just looks way too conservative. Yeah. And, that it probably is.
Don't mind
They'll
that.
upgrade in the second half. And,
one of the stocks in the AI space has been affected by COVID, Altium, Ben. Again, they've had a couple of profit warnings. And this result didn't even meet that last level. So it was a very tough year for them.
It was. And a disappointing set of numbers that the market has largely looked through. They've really been affected by their customers have laid off staff, which has meant that during the COVID environment, which meant they were selling less licenses. They also made the decision not to cut their prices or offer more favourable terms. And their CEO, Aram, sort of spoke about, after 8 years of phenomenal growth, we really use this as an opportunity to reset the business, to restructure the business, to go back to focusing on what we wanted, take some cost out. And I really think some of these tech businesses, some of these healthcare businesses, like, your Cochlears and ResMeds and stuff like that, they're probably a year behind the Seeks and REAs because they're still operating in such a COVID-affected market. Whereas our companies are coming out of it now because we've got the virus under control.
The term RM used was something like parking or parking hub.
Pit stop.
Pit stop.
Yeah.
And the reflection back on CSL is interesting, and what they did when they made their big investment years and their big change years, it's all come home to roost now. So I think with Altium that we're going to see the results in a few years' time. We know they're winners. He's an absolutely proven performer. And this is that year where you have a pit stop.
I think it's a 2022 story with a lot of these companies. That's when you're going to see the earnings really start to recover. But when the market starts to price that in, could be towards
Before that,
second half of this year, maybe.
This year, which
Yeah.
is okay. It's good to know that. Well, we've got another couple of weeks of busy reporting, and we're going to bring another insights to you later in the month. But for now, that's all we've got.